Which is the best private bank to invest in India? I compared private bank performance on various parameters and these are the results. 1. Profit. For banks, income comes from two sources: net interest income and other income. Banks earn interest income for the loans they have given to the customers. Banks pay interest to the customers whose deposit bank is keeping. So the difference between this interest earned and interest paid is the net interest income. We can compare the net interest income of the banks by comparing the net interest margin of the banks. See the table, and from the table you can understand that Kotak Mahindra Bank is having the highest net interest margin. As expected, HDFC Bank is having the lowest net interest margin. This is the main reason why HDFC Bank stocks prices have come down drastically in recent days. In addition to interest income, banks receives fee for the services it provides to customers like loan processing fee, credit card charges, etc. Banks also have investment from which they receive dividend amounts. All this come to the other category of income. I have divided other income with total income of the bank to see whether this parameters is significant. For IndusInd and Axis Bank, around 30% of their income comes from these other sources. This component is significant for banks as it is contributing 1/4 to 1/3 of the income for most banks. And the above comparisons are giving hints of only the income. Income is one part of the equation and expense is the other part. What remains after income and expense is profit. Let's compare profit after tax. How can I compare profit after tax of different banks of different sizes? So this is a problem. Net profit margin figures are not readily available on any bank quarterly presentation reports. I am unable to reach to any conclusion for investments without considering profit. So I decided to compare each bank with HDFC Bank to find out how small the bank is in comparison with HDFC Bank. I chose HDFC Bank because it is the biggest private sector bank and it has a decent reputation of doing things very efficiently. My idea is to compare profit after tax of these banks with HDFC Bank. If the profits the bank generates with respect to HDFC Bank is higher compared to the size of the bank with respect to HDFC Bank, then the bank is working more efficiently than HDFC. But what parameters should I compare to determine the size of the bank? Is it deposit or income? I decided to compare deposit of these banks with deposit of HDFC Bank because deposit are raw material for banks. Even if I compare net income, the results are coming almost similar. So I divided each bank's deposit by HDFC Bank. HDFC Bank is having a total deposit of 22,14,000 crore. ICICI is 60% of HDFC in deposits. Kotak Mahindra Bank is 18% of HDFC in deposit size. Similarly, Axis Bank is 45% of HDFC Bank in deposits and IndusInd Bank is 17% of HDFC Bank in deposit size. Next, I divided each bank's quarterly profit after tax with profit after tax of HDFC Bank. So, ICICI Bank, which is 60% of HDFC in deposit size, is generating profit which is 67% in comparison with HDFC Bank profits. So ICICI is doing better than HDFC. Similarly, Kotak Mahindra Bank with a size multiplier of 0.18 is generating a profit multiplier of 0.26. So it is performing far better than HDFC Bank and performing better than even ICICI Bank also. Unfortunately, Axis Bank with a size multiplier of 0.45 is able to generate only a profit multiplier of 0.37 in comparison with HDFC Bank profits and faring badly than HDFC Bank. You can see IndusInd Bank is faring behind HDFC with a size multiplier of 0.17 and profit multiplier of 0.14%. So Kotak Mahindra Bank is emerging as the winner in most of these parameters related to profits and are having a pretty decent year-on-year profit after tax growth of 30%. ICICI Bank is in second position and HDFC Bank is in third spot, followed by IndusInd Bank and Axis Bank. Next, we compare return on asset and return on equity figures. As you all know, return on equity and return on asset are two measures to determine how efficient a company is generating its profits. Return on equity is the net income divided by shareholders' equity, and return on asset is the net income divided by total assets. So Kotak Mahindra Bank is having the highest return on asset but the lowest return on equity. And Axis Bank is having the opposite case with highest return on equity and lowest return on asset. Return on equity and return on asset of ICICI Bank is pretty decent. HDFC Bank is faring better than IndusInd Bank. Why there is huge deviation in return on asset and return on equity for Axis Bank and Kotak Mahindra Bank? Ideally, if return on asset is high, then return on equity should be high or vice versa. To analyze this, let us find out how return on asset and return on equity are related. Return on equity is net profit by equity. That is net profit by asset into asset by equity. Asset by equity is a ratio that is an indicator of company's leverage or debt. So return on equity is return on asset into degree of leverage. It shows return on equity is higher than return on asset due to benefit of leverage when asset by equity is greater than 1 due to impact of debt employed in a business. Axis Bank is having high return on equity. So the debt component of Axis Bank should be high. Let's analyze. I have the figure for borrowing of banks. Let us check whether this is true. Let me compare Axis Bank and Kotak Mahindra Bank. Earlier we have seen that Axis Bank is only 45% of HDFC Bank in deposit and Kotak Mahindra Bank is 18% of HDFC Bank in deposit. So Axis Bank is almost 2.5 times bigger than Kotak Mahindra Bank in deposit. Axis Bank has a borrowing of 1.95 lakh crore and Kotak Mahindra Bank is having a borrowing of 25,000 crore. If we compare borrowings of Axis Bank with Kotak Mahindra Bank, Axis Bank is having 7.5 times more borrowing than Kotak Mahindra Bank, whereas Axis is only 2.5 times bigger than Kotak Mahindra Bank in deposit size. This clearly indicates that the higher debt component of Axis Bank has resulted in high return on equity. Lower debt component of Kotak Mahindra Bank is the reason for low return on equity for Kotak Mahindra Bank. This equation is again favoring Kotak Mahindra Bank. So as we have discussed about the borrowings, let us compare the borrowings of various banks with HDFC Bank. You can see the numbers in the table in the screen. The table opens us to a stark reality that all banks are performing better than HDFC Bank in borrowings. All of these banks are having a lower borrowings ratio than its deposit size compared to HDFC. So HDFC is faring very bad in this parameter and is heavily dependent on borrowings. I will introduce one more parameter in respect to HDFC Bank, loan to deposit ratio. Banks depend on the deposit they receive to issue loans to customer. Ideally, the bank should issue less loans compared to the deposits. Typically, the ideal loan to deposit ratio is 80% to 90%. But HDFC Bank is having a high LDR ratio of around 110%. It is issuing more loans than the deposits they are keeping, and these loans are funded from borrowings. This is one of the reasons for the sharp drop in HDFC Bank stock prices recently. This ratio was around 85% before the merger. HDFC management is claiming that they are borrowing money at better rates than the term deposits and using the relatively cheap money they are getting from borrowings for the loans. Next, we will go to capital and asset quality ratio as we have already discussed about the profitability indicators. The capital adequacy ratio ensures that the banks have sufficient space to take any reasonable amount of losses before they become insolvent. It is used to protect depositors and promote stability and efficiency of financial system. So Kotak Mahindra Bank is having the highest capital adequacy ratio. Axis Bank is having the lowest capital adequacy ratio. Surprisingly, ICICI Bank, which was leading in most of the profitability parameters, is lagging in capital adequacy ratio and it is the second lowest. ICICI Bank is also having second highest net NPA. Net NPA is a measure of the actual losses that a bank has incurred on its non-performing assets. A high net NPA indicates that the bank has incurred high losses on its NPA. It can be a sign of a financial problem for the bank. IndusInd Bank is having the highest net NPA, followed by ICICI Bank. HDFC Bank is performing best in net NPA, followed by Kotak Mahindra Bank. Provisioning coverage ratio, which is another indicator to measure how much provisions the bank has kept to deal with bad loans. So banks generally keep a provisions for potential loan losses, and PCR or provisioning coverage ratio is the ratio between the provisions kept by the bank to the total amount of gross non-performing assets the bank has on its book. Higher the ratio of provisioning coverage ratio, it is better. ICICI Bank is keeping high provisioning coverage ratio, followed by Kotak Mahindra Bank, Axis Bank, HDFC Bank. IndusInd Bank is performing the worst in this parameter also. So now we have seen that IndusInd Bank is performing very badly in profitability and asset quality ratio compared to other banks. So I am dropping IndusInd Bank from our analysis. Let us compare the 4 banks which are remaining to find out which is having the most attractive valuation. I have explained in all my previous videos that price to book value is used for banks and not price to earning ratio. But book value for a bank is the difference between its assets and liabilities. Asset for the bank is the loans that are given to the customer, and liabilities are the deposit collected from the customers. So the bank do the business with these assets and liabilities, and that is the banks do business with its book value. So price to book value is compared for banks and not price to earning ratios. From the figures, we find that Axis Bank is available at the lowest valuation, followed by HDFC, Kotak Mahindra Bank and ICICI Bank. As an investor, I would consider buying Kotak Mahindra Bank as it is doing very well on most of the parameters related to profitability, capital ratios and asset quality. It is available at reasonable valuation also. I will not invest in Axis Bank because of its low profitability ratio and low capital adequacy ratio. Now, between HDFC Bank and ICICI Bank, it is a tough question. When I made my first video, right time to invest in banks, HDFC Bank and ICICI Bank were available at almost similar price to book value ratio. But in a span of 1.5 to 2 months, the value of HDFC Bank has declined so drastically. So now ICICI Bank is available at a higher valuation. It is performing very well on profitability parameters, but it is lagging slightly in asset quality and capital adequacy ratios. HDFC figures are not very impressive, but valuation wise it is coming very attractive. HDFC Bank's figures are affected by the merger. HDFC Bank's net interest margin was above 4% before merger, and after merger it has come to the range of 3.4%. Similarly, loan to deposit ratio was 85% before the merger, but after the merger it has come to around 110%. HDFC Bank is having one of the best asset quality in the industry even now. HDFC Bank is currently available at one of the lowest valuation over the years. See the figures of price to book value from financial year 18 to financial year 24. HDFC Limited has merged with HDFC Bank on July 1, 2023, and HDFC management is expecting huge cross-selling opportunity post-merger. HDFC Limited had 40 million customers, out of which 30% were existing customers of HDFC Bank during the time of merger. So there is 70% of customers who are probable target for HDFC Bank to increase its customer base. Similarly, for HDFC Bank also they have advantage. HDFC Bank has around 8 crore customers. 2% of them have taken home loans from HDFC Limited. 5% of them have taken home loans from other banks. So there is a huge cross-sell opportunity for this 93% of customers who have not taken house loan from HDFC, and also HDFC can plan to acquire the existing loans of the 5% of customers who have taken loan from other banks. HDFC Bank is investing a healthy bank branch addition every year. They are targeting around 1,500 branch openings per year. They are building this infrastructure focusing 8 to 10 years in pipeline. Branches are very essential for having granular and sustainable deposit. The only differentiation for bank in future is how well they engage with the customers. Human touch is going to be the differentiator in future for the banks. That is the reason why HDFC is investing a lot of its profits every year for branch expansion. HDFC is also rapidly entering to rural parts with core focus on acquiring the wealthy customers in the rural parts. HDFC Bank have consistent healthy financial performance, comfortable asset quality, good capitalization levels, experienced management and a widespread branch network. So when this bank is available at such a low valuation after many years, my mind is saying why not to invest in HDFC Bank. Private banks are going through a cycle where they are having a lot of negative sentiments and there are limited reasons for it. Currently, we are in top of an interest rate cycle and RBI has advised banks to keep a higher capital for unsecured loans. But these are having marginally low impact and the stock prices of some of the private banks are not going up. As an investor, I feel it is good time to invest in private banks. Kotak Mahindra Bank, ICICI Bank and HDFC Bank looks promising. I will wind up this session with two interesting data points on banking credit I have recently found in HDFC Bank quarterly presentation. First is regarding banking sector credit growth, which is growing at almost 2 times of GDP growth from the year 2010 to 2023. As India's GDP growth is expected to stay stable and promising, we can expect good credit growth in future as well. Second data point is about share of private banks in banking credit. In 2011 to 2014, only 21% of the banking credit was funded by private banks, but in 2019 to 2023, the figure has increased from 21 to 37%. So, private banks are taking market share of banking credit. So when the valuations of private banks seems to be very reasonable and potential downside risks are very low, why not to consider investing in private bank? I hope you have enjoyed this video. I have made the video to share my thoughts about this sector and this is only for informational and educational purposes. I am doing this analysis as a hobby. I think it would benefit you if you are subscribing to my channel as I strive to create good content.